Hi everybody, Ken Calhoun from TradeMastery.com with our channel dedicated to helping you become more successful in your active day and swing stock trades. In today's episode, we're going to look at not one but two winning gap calls that our live room members got last week, this past couple of days. What I want you to get out of today's episode is the difference between winning gaps and gaps that chop around or gaps that fade back. My favorite chart pattern is gap continuations that keep running on up with high volatility and momentum after we put on the trade. Let's take a look at how well those worked out coming up next. As you all know, I like stocks over $15, preferably $20 a share, up as high as $30, $40, $50 a share, because they tend to run farther than the cheap stocks do. Let's take a look at this first chart in First Solar. On this gap, notice a couple of things. One is that it didn't gap up multiple points. It did a modest gap and it ran strongly after the initial bullish cup pattern. I got our traders in at 33.50 was my long call, and we closed out the position, paper trading only, right under 35. So in at 33.5, out right under the 35 whole number resistance. That brings us to the first learning point. Whenever you're looking for gaps, look to always enter above the cup pattern that's formed pre-market, and then exit nearest the nearest whole number as it continues to run on up to new highs. The reason for this is oftentimes stocks will stall out at whole number resistance, so it's a good idea to sell into the 90 cent or 95 cent area right under that whole number resistance trigger. That's why this First Solar call worked out so nicely. It's one of the best recent gap calls this last week or two our live room members got. And take a look at the difference between how exceptionally strong this gap is compared to some of the cheap stocks. For example, here's a couple of horrible charts for gaps. Notice how cheap and choppy they are. The problem with trading, especially day trading under $10 stocks, is that the gaps usually, the vast majority of the time, will not go more than 20, 30, 40 cents, which means you've got to absorb a lot of upfront risk trading thousands of shares, which is really foolish if you're a new trader. You and I both know that trading can be difficult, so you want to minimize your risk on the front end by trading charts with wide trading ranges that are easier to get 50 or 70 cents out of. That just doesn't happen on under $10 stocks. At best, you may get 20, 30 cents, and that's not worthwhile. The math doesn't add up. Always brings another point up. Always look at the math behind the charts. The math behind cheap charts is that you have to over leverage on large share size. Just like foolishly trading E-mini futures contracts, you've got to leverage up and absorb way too much upfront risk to make the numbers work out on the back end. I prefer charts like this First Solar chart because the point range makes for a much easier trading time, and it makes for an easier way to get 50, 80 cents, a buck out of the chart if it's got a multi-point range. If it's a chart that's cheap and under $5 or $10, it's much tougher to. So it's usually an awful idea to trade cheap under $10 stocks because they don't run very far. So to compensate, you've got to trade thousands of shares to make the most out of a 10 or 20 cent scalp. That's far too risky and foolish, and far too many traders blow up their trading accounts with the scalpers over 1,000 share type of approach. It makes a lot more sense, at least in my professional estimation. What I like to trade are things $15, $20, $30 a share that have a good 1 or 1.5 point range, of which I may get 50 or 80 cents on a gap continuation. That's the right way to trade gaps. Let's take a look at a second gap play, SQ, the ticker. And in our live trading open room today, I alerted my members to look for a long if it breaks above 1940, which it did. It skyrocketed on up, and we got out right under the 20 whole number resistance for a good 50, 60 cent breakout range. That's the type of gap that makes sense to trade. You don't have to trade expensive $70, $80, $100 share stocks, but neither should you be looking at cheap under $10 stocks. They don't run like this. And to wrap things up, kind of the icing on the cake, one question that traders around the world have asked me for years is how to trade pivots correctly. As with all the charts that I like to trade in my own capital trading accounts, I prefer charts with wide ranges. Or in the case of pivot charts, I like ones that move down sharply and then start to bounce after a sustained or extended sell-off. And you can see VIAB from today. Really good chart. Take a look at this chart. My members got in, we got in at 36.7. It was 36.7 on the entry, out just under 38 for a full 1 point plus winning alert for our members in the live trading room. What do you notice about VIAB that's different than other sell-off charts? Give a quick look. Take a quick look at the chart and tell me, what do you notice about this chart compared to charts that you may have personally struggled with when it comes to trading pivots? What I notice about this chart immediately is that, like a good camera lens, it's focused, sharp, and clear, just like this image, right? Nice, clean breakout or breakdown pivot charts have very clean, well-defined trading ranges. They're not choppy and fuzzy and up and down. They're characterized by kind of like a Sharpie marker if you're to draw a very clean, tight trading range. Makes for a much easier entry and exit. You always want to sweep aside cheap charts. Just say no. Stop the madness. There's got to be a better way. Trade clean, well-defined charts with multi-point ranges. That's much more intelligent for professional day trading the stock market, as I've done since the late 90s, than trading these cheap under $10 low cap, low float, small cap, low float junk stocks that you have to trade thousands of shares to get a 10 or 20 cent move. That's a recipe for epic fail. Just say no. Instead, trade charts with wide, cleanly defined trading ranges on high volume of at least 15, that's 15,000 shares per minute, absolute minimum, with nice, cleanly defined, well-defined charts that are easier to trade. Makes for a much easier path for your trade. So I hope that helps. Anyway, as always, feel free to leave a comment below. Be sure to subscribe to this channel so that you can get updated every time I've got a new video. I like to produce at least one, sometimes two a week, so you can see new strategies designed to help you become more effective in your trading entries and exits for both day and swing trades. So until next time, trade with passion, trade with really tight stops, and try and make as much money as you can in your active trades. Goodbye, everybody. And for a little bit of fun today, let's welcome my alter ego to the stage, Sergeant Ken. He's a drill sergeant. If you've ever seen those military movies, here's a good example of how to improve your discipline as a trader. Welcome to the stage, Sergeant Ken. What is your major malfunction, numbnuts? Didn't anybody tell you trading is war? You've got to be relentless and trade smarter if you're going to make money, because trading is one uphill battle. You make choices, you've got to deal with them. Grow a pair, get unstoppable, and crush it. So you're still losing money as a trader. Boo freaking who? Why exactly is that, Buttercup? Could it be you're still trading E-mini futures, duh, or binary options, or penny stocks, or cheap as fuck under $5 stocks? What were you thinking? Is there anybody home? No tropical islands, bikini babes, or fancy sports cars for you, recruit. This is the part where you decide to get with the program. Join my buddy Ken at TradeMastery.com and learn how to trade stocks the right way. Dismissed. Wow, that was good. Thanks. Now I hope that helps give you some encouragement and motivation to become a little more disciplined in your own trading approach so you can make a go of this and make it work out for you. Till next time, take care and trade well.